will use SUVs from Lucid Motors equipped with self-driving tech from Nuro. The move puts the company in direct competition with Alphabet's Waymo, which already operates in San Francisco. Tom, I'm just not there yet. Call me old-fashioned. Back over to you.
Courtney, I'm right there with you. Thank you very much for that. Coming up on the show, we're 30 minutes away from the big Fed rate decision. Stocks are still gaining right now, with Caterpillar, NVIDIA, and Verizon pushing the Dow higher. We're going to discuss more of the day's biggest movers when the exchange returns after this break. All right, welcome back to the exchange. Gold prices rising today as investors await the Fed's big decision on rates, but down nearly 3% this week overall. Tim, I'm going to turn to you first. You've been bullish on gold for quite some time now. A big fan of the mining stocks that are the ancillary play on the gold prices themselves. Are you sticking with that trade?
Absolutely. This is a multi-year trade. This is a trade that's as much about supply. I know we only think about central banks buying. It's an asset class story. It's miners, the free cash flow yields with gold at 4,000 are extraordinary. Those are not priced into these stocks. So I love it. I actually think it's a very interesting time to find those miners also with exposure to copper. Fresh, kind of big rally today. Look at the Southern Copper announcement yesterday. I mean, their earnings were record earnings. So I think copper, gold, copper hybrid, some industrial metals on top of the PGMs, get your exposure and stay there.
All right, so gold and PGMs aside, just a bigger, broader question. Are you now, do you feel as though, Barbara, investors are, generally speaking, over or under allocated to precious metals?
I think they're probably under allocated institutional investors. I think the retail investors have been all over gold and silver, but that's, I think, more momentum plays. But I think institutional investors have typically seen gold as a hedge against inflation, geopolitical uncertainty, et cetera. And I'm with Tim. I think there's actually real secular changes, and I think it's the central bank buying that will continue to push up the price of gold. So I think there's maybe some reevaluation there, but I think it is underweighted in general.
And what do you think it could do? Do you feel as though there's a market improvement for prices in the next 12 months?
I do. I think, and the way I'm playing it, I'm not playing the gold miners. I'm doing it through the GLD, through the ETF. So, and I started putting that in all my client portfolios earlier this year and in my own, because I think that we'll just continue to climb higher with the understandable pullbacks after
lead time on a gold mine is 7 to 8 years. Everybody thinks you can just crank out more gold out of the ground. It's not happening.
All right. Now, the Fed is also meeting not the only central bank, by the way, that's in focus this week here. The Bank of Canada, the European Central Bank, the Bank of Japan, they're also set to meet on policy. The Nikkei actually closed at an all-time high today. The Stoxx 600 in Europe is up 13% this year. So let's talk a little bit about that international play. I will start with you, Barbara, on this. The international side of things, is it attractive, and are there specific markets that you think are the ones poised to outperform?
Yeah, well, in general, I look at international markets or investing in them as trades, maybe short, maybe a year or two, or like, for instance, China, which was considered uninvestable for a while. Well, right now they seem to have in their moment in the sun, but I also continue to see it high risk given government, potential for government sudden actions. Europe has had a great run this year, and part of that was, again, the defense spending, fiscal spending, and a lot of things that were sort of short-term or one-time. They still have serious issues in terms of the structural challenges. Our country, I still remain overweighted in the U.S., and I always will be, just because unless things really change down the road, because this idea of American exceptionalism, I think, is real. And that's about innovation. It's our company earnings are higher, our margins are higher, we have flexibility in our workforce, and that's going to continue. And of course, we all know about this AI cycle, and what the potential, the productivity increases we're going to see over the coming years is dramatic. So I think there's still a lot of money to be made in our market.
Tim, you made a lot of your bones early on being a global investor. So where do you think the opportunities are now? IDEVO
is an ETF I run right now. It's an international ETF, and we're exposed to some of these themes. I mean, Japanese industrial companies, I think, look fascinating on valuation. I think Japanese companies are giving more capital back to corporate government. It's all about relative improvement. European banks, European money center banks. If you think Citibank and JP Morgan have been good trades, we've been in Barclays, we've been in Santander, and I just think the international allocation, we're seeing this. We're seeing a lot of inflow. The dynamic here is U.S. investors are underweight international. U.S. exceptionals, I'm not here to challenge that. In fact, I would just say that there's an underweight there's an underweight international by U.S. investors. There's an underweight their own markets by foreign investors. And I think some of this really started back in Trump 1.0, where I think we went from, foreign investors went from kind of, 18% to 25 to almost 30% U.S. I think some of that's coming back. I think international is a long-term trade.
All right. Coming up on the show, a quarter-point cut is more so baked in at this point. So many investors are setting their sights on the Fed balance sheet action. So what the potential end of quantitative tightening might mean for the bond market, that story is coming up next. All right, welcome back. We are now just about 17 minutes and 22 seconds away from the Fed's big rate decision. Yields are holding steady with the 10-year just under 4%. With the market already pricing in a 1/4 percentage point cut, my next guests are now focusing on the potential end of quantitative tightening. So joining us now are Michael Schumacher, head of macro strategy over at Wells Fargo, and Ross Mayfield, investment strategist over at Baird. Thank you, gentlemen, both for being here. Michael, we're going to start with you. This is probably one of the more telegraphed rate moves that the Fed has seen, and the markets are playing it that way as well. What exactly do we need to see or hear from the Fed later on today with regard to what the next steps are for Wall Street?
Yeah, Dom, it is telegraphed. I agree with that. And it's not simply because you've got this move just about baked in, but there's been effectively no economic data for the last month. So nothing really to change the Fed's mind in terms of the path. What people are focused on is the balance sheet. Is the Fed going to announce that today is the day the Fed stops running it down? Probably not, but it may actually do it for forward start. So it might do this for December 1st or something like that. I think the big surprise to the markets would be if the Fed said, no, we're good. We'll just let the balance sheet run down a bit more and we'll evaluate next meeting. That would be a shock.
Michael, we've spoken now for a decade and a half about rates. And every time we come to you about questions on rates, you give us these very simple and simplistic answers that kind of clarify things for us. So for our viewers out there, what exactly is the most important thing for rates in the next, say, 6 to 12 months?
I think probably the most important thing for rates is really, I'm going to say two things, so not just one. But number one is, what's the evolution of all the tariff discussion? The tariff hit on the U.S. economy has been less than I expected, less than a lot of people expected. If we go back to April 2nd, Liberation Day, and say, would the U.S. economy, would we have expected it to be in this great shape? Probably not. So does that continue, or is the tariff hit simply delayed? That's the first thing. And secondly, how do people at the central banks like the Fed react? So right now, I'll give you an example. The market expects the Fed to ease about 100 basis points more, putting the funds rate down to about 3%. Does Powell endorse that idea today? Does the Fed really follow through in the next few months? These are the big things people need to weigh over the next, call it, 6 to 12 months.
All right, Ross, from an equities perspective, how much is the rate picture necessary for the next leg hypothetically higher in the marketplace?
Look, I think it's a leg that the bull market stands on, but it's not the main one, right? We know the AI trade is primarily fueling this. Now, there is a lot of easing baked into the market. So I think on one hand, you know, the idea of lower interest rates sparking some of the cyclical corners of the market, the housing trade, for instance, is important, but it's also baked into the market. I mean, we look at Fed fund futures, and again, 125 basis points more of easing, plus the end of QT, which is more, easing of financial conditions. So it's clearly a big part of this. You know, we don't have a lot of data points, but Fed rate cuts plus no recession has been a very potent mix throughout history. And I think we're sitting there today, but it's far second to AI and the developments on the front of the Mag 7 and some of the other players in that space.
And Ross, how important is that balance sheet policy or clarification on policy going to be for those equity markets?
Maybe important on the margins. I do think, you know, if Powell were to come out and surprise the market by saying that we're just going to keep letting the balance sheet run and continue quantitative tightening into perpetuity, I think it might be a bit of a shock to equity markets. We've seen some stress in short-term funding markets. I think that's actually the impetus for Powell to maybe pull this QT end forward into today. But if we're looking out long-term as to what matters, I think in addition to tariffs and to how the Federal Reserve reaction function works, we're looking at inflation. I mean, we've seen inflation come down, but we've also seen inflation ex shelter start to tick up month over month for the last several months. So there's this stickiness to inflation that I think will probably keep the Fed from cutting anywhere past their neutral rate. And I think so then you start to think about 2027, where does the Fed end up? And that's a much more interesting, I think, thought experiment, because 2026, I think, is fairly well laid out by the Fed.
All right, Michael Schumacher at Wells Fargo, Ross Mayfield at Baird. Thank you guys very much for that. Coming up on the show, energy, tech, and industrials are leading the way ahead of the Fed decision in just about 12 minutes and 45 seconds. Real estate and staples are the laggards. The exchange is back after this. Welcome back. 9 minutes, 45 seconds away from the big Fed rate decision. Let's get some final thoughts. And Barbara, we're going to start with you here. What exactly would you be watching for, mostly from the press conference at this point?
For the Fed, well, we obviously want to hear what he's thinking for the future. Everybody's expecting a 25 bips cut, but we'll see what he thinks in terms of December and what he thinks in terms of inflation and labor. Those are the two key things. And so lots going to key off that in terms of where we go. I think for now, the AI play is strong. You've got huge consumer spending, some 40 to 50 trillion, and wealth has been created since 2019. So next year looks good. So I'm not even so sure we need to have clarity on how many rate cuts for next year, because I think earnings look very strong and the guidance has been very strong.
Tim, what do you think?
Well, and I think the lack of clarity gives the Fed an ability. I mean, Powell could actually really punt on December language. And it doesn't mean he won't give some guide, but my inclination is if you've got a 90% priced in on December, I think there's the risk that you could be disappointing people. I think over the next couple of days, I think bond markets and rates could give a little something back. I think we've priced a lot of this in. And, I've as stated earlier, I'm generally very constructive on the market here. We've had a 15% move in the S&P since the other side of the V. In other words, we've had a massive move in markets, and we've priced a ton of Fed in, not just a little. Don't fight the Fed. I think this Fed, at least that's intact for the next 6 months or more, is going to follow the course they have. They don't have to go in December, but if anything, I think just watch for more caution out of December.
For the last few moments, just a few seconds left here. Favorite part of the market right now?
I tell you, it's not a big weighting, but I really like what's going on in commodities. I like what's going on in integrated miners. Again, I talked about copper. I think industrial metals. I think the defense spend build out around the world, whether it's Japan or Europe. I kind of like that part of the market. Industrials have led the S&P all year.
Barbara, what do you think?
Still the AI chips, NVIDIA, Broadcom, TSM. So.
Okay, so heading to the Fed. Thank you guys both very much for breaking it down all with us right now. Barbara Durant and also Tim Seymour, thank you very much for that. Now, that does it for the exchange. We're just a few minutes away from that big Fed rate decision. I'm going to see you on the other side of this break on Power Lunch for the entire Fed breakdown. Keep it right here. We'll see you after that. All right, welcome to Power Lunch. I'm Dominic Chu in for Brian Sullivan today. We are just about, call it less than 5 minutes away until that very key Fed rate decision. We're going to bring you that decision, the market reaction, and what it all means for your money straight ahead. But first, let's get a check on the markets. All-time highs for each of the major indices out there. The S&P's up 0.25%, fractional gains for the NASDAQ Composite, the Dow Industrials, the NASDAQ 100 Large Cap Index as well. Right now, let's get right to our all-star panel as we get just closer and closer to that big Fed rate decision. Joining us now are Jim Caron of Morgan Stanley Investment Management, David Kelly of JP Morgan Asset Management, also Francis Donald of RBC Capital Markets. Again, all-star panel to break all of this down. Let's first, though, get out maybe have the conversation a little bit first about what's happening overall for that big rate decision coming up. We're going to get out to Steve Leisman. Actually, we're going to stay right here. We'll get to him in just a moment. He's in lockup right now. So, David, we're going to start with you.
Yep.
This is perhaps one of the more telegraphed, if you will, rate decisions that we've had in recent memory. Is there anything that we're going to expect that could change the narrative one way or the other based upon not just the decision, but what we hear from Jerome Powell in 30 minutes after that decision comes out?
I think on the rate cut itself and on the prospects, it is pretty much telegraphed to markets. But I think the interesting issue is going to be quantitative tightening. We've seen some spike up in short-term rates. They've been gradually reducing their balance sheet. I think they're going to come to an end to that. I put an end to that because they don't want to cause volatility in short-term markets. So I think that's the first thing. And then it'll be really interesting in the press conference to see just how far the Fed is telegraphing rate cuts. Are they really slowly coming down to neutral, or are they going to stop short of that if the economy is looking fairly strong?
Do you think that it would be in their best interest to do that, or do you think that they want to keep things in more of a wait and see to provide that optionality when and if data actually starts coming out again?
If I were in their shoes, honestly, I wouldn't cut at all. And the reason is I think the economy is doing okay, but these markets are bubbly, and you've got a lot of animal spirits running rampant here. And when you go to the zoo, they say don't feed the animals. I think the Federal Reserve shouldn't feed the animals here. I think they should not feed these animal spirits at this point because the market has got a lot of euphoria in it.
Jim, are we feeding the animals or not?
Well, look, I like to differentiate between the market and the economy. The economy's not the market's not the economy. So when I think about this, I think about the jobs market. And what I'm going to be looking for in this decision and the commentary from the Fed is how are they assessing the data? What private sector data are they looking at, or what other indicators are they seeing? Because ultimately what it means to me and what I think it means to the Fed is if the labor market is slowing or non-dynamic, then what we need to see is further rate cuts. Yes, I know that the inflation is above target right now, but as long as the unemployment rate is likely to rise, and by the way, I think the unemployment rate is truly closer to 5% than the 4.3% that we last got, based on some of the private market surveys. So I think the Fed is very wary about that, and that probably puts a couple more rate cuts in front of them.
All right. Now, Francis, if we turn towards you, there have been allusions now from both of our guests here on the panel with regard to kind of what other data points might be at play. From your standpoint, what were you looking at over the course of the last few weeks in the absence of any official government data coming out, ex the CPI print we got last week?
Quantitative data from the private sector and also some qualitative data from the beige book. But that's exactly what I want to hear from Powell today is we have a sense of what their decision-making function is, but what are they going to be reacting to? Because this isn't just about 1 month of lost data. We're going to have several months here where the data is going to be very skewed, very difficult to get a core read, especially on the inflation side. That's really hard to look backwards on and tell us where we were 3 months ago. So I want to hear from Powell today. This is what we're going to be looking at, not just how we're going to be reacting to the economy ahead.
Now, Francis, one quick point here before we get to that decision. From a data standpoint, do you feel constructive about what the economy is doing right now as we head into this print?
No, this is what we call stagflation light type of environment. It is growth below comfort level, and it is certainly inflation above comfort level. I don't know what the Fed's trying to achieve with these rate cuts here, maybe not being as restrictive, but a lot of the job weakness that we've seen is that low hiring, low firing results from a trade shock that's coming through. Right. I'm not sure that these rate cuts that we're seeing from the Fed is going to cure what ails the American economy.
All right, Francis, hold it right there. Let's get out to Steve Leisman for the big rate decision. Steve.
the Federal Reserve cutting interest rates by 1/4 point to a new range of 3.75 to 4%. There were 2 dissents on this. The second one by new Fed Governor Myron, who wanted 50. First one by Kansas City Fed President Jeff Smith, who wanted no change. So dissents on both sides, a kind of a rare occurrence for the Fed. The Federal Reserve announcing it is stopping quantitative tightening or the roll-off of its balance sheet as soon as December. All roll-offs of treasuries from here on out and mortgage-backed securities on the Fed's balance sheet will now be invested into T-bills. It's a bit of a change there. On the economy, the Fed said economic activity expanded at a moderate pace, according to available indicators, one of 2 nods in the statement to the absence of data by the Federal Reserve. It had said in September that the economy was moderating, so almost a bit of an upgrade to the economy, but according to available data. Job gains, it said, has slowed, however. Unemployment remained low through August. And again, it said more recent indicators are consistent with these developments. That's another nod to the idea that the Fed doesn't really have the official data. More recent indicators is what it's using. Inflation, it says, has moved up since earlier this year and remains somewhat elevated. That is the same characterization as September. And there's not much in the way of forecasting the future path of rates. I believe that'll have to wait for the press conference from Fed Chair Powell. But again, the Fed cutting by 1/4, 2 dissents on both sides of the issue. One wanted more, one wanted none at all, and the Fed stopping quantitative tightening as of December. Guys?
All right, Steve Leisman, please stick around here. Let's get back to our panel for some reaction here. Jim, I'm going to start with you first. We showed the charts of the market reaction. Equity markets have been relatively stable as they were going into this print. The curve from the 2-year all the way to the 30 have moved maybe higher by anywhere from what I could see 1 to 3 basis points. This is all about the Fed rate press conference now at this point. But what stood out to you from hearing what you heard from Steve and then what you saw or didn't see from the market reaction?
So that's a great question. So I think that we are in the sweet spot of policy uncertainty for markets. And what I mean by that is that we're expecting there to be better growth in 2026. But at the same time, we're also expecting the Fed to cut interest rates. So you may have higher growth. You may have a labor market which is keeping wage inflation and wages relatively, stable, which keeps profit margins high for companies. And again, better growth, lower rates, you're discounting those future cash flows at a lower rate, you're increasing the present value, and what it's doing is it's supporting valuation. So this uncertainty that's being discussed right now with the labor market and what Fed policy is likely to do and lower interest rates, equities are the beneficiary.
Okay, David, you see it all from an asset management perspective. Does this change at all anything with regard to how you view future allocations, how new client money gets put to work? What exactly does this mean in the construct of how investors have to view what this rate decision will mean for them?
Well, I think the one interesting thing was that dissent in terms of not cutting at all from the Kansas City Fed president. I think that is really interesting because it says that there's some pushback, and I think the pushback isn't about the economy. I think it is about how strong markets have been this year, and if that gathers a little momentum, we may see a Fed easing a little bit more slowly next year, so maybe not heading straight down to 3%. In terms of investors here, I think it's been a wonderful year for investors, but that follows 2 great years, and I'd say rebalance, rebalance, rebalance. I mean, I think people just need to look at the risk side of their portfolios and not just the very strong gains that we've seen in equity markets.
Francis, you used the word, I'm going to bring it up again, you used stagflationary as part of your response to my previous question. Do you feel any differently or similarly based upon what you heard from Steve? I know that we're going to break down the entire kind of report and the press conference afterwards, but do you still feel as though this is a market that is going to succumb to stagflationary pressures in the coming months?
Well, we have the qualifier stagflation light, in that this is clearly a long way from the 1970s, but look at what the statement says. It flags exactly that scenario. We have job gains that have moderated. We have inflation that has moved up. And that's okay for right now because the unemployment rate hasn't broken out. The bottom hasn't fallen out. And inflation, while I would say is still too high, is not up at that 4 handle. But one of these sides of this stagflation environment is going to break, and the Fed is not going to have the same luxury middle of 2026 as it does now to play both sides of that. And even in the dissents, you can see we're getting dissents on both sides of the mandate right now. That's a real call out to that. This equilibrium that we're in, it's not going to last forever. Our view is that inflation is going to turn out to be the real problem, and heading into 2026, this Fed is not going to have the ability to point to the job market to the same extent as they have now. They're going to have to slow down here when they see inflation rising further into Q1.
Francis, at multiple points over the past few months, we've heard Fed Chair Jerome Powell make public statements to the effect or the tune of that there is no risk-free path going forward with regard to inflation and or slowing job market. So you mentioned inflation being the one that you think could be keyed upon more. What exactly is that preponderance of risk for the economy vis-a-vis the markets? Do you feel as though there is a tilt one way or the other based upon what we know or what we, I guess, don't know about the economy?
Yeah, lots in that question. And I agree that inflation is going to be the bigger part of this story. And particularly, we heard my colleagues here on this panel talk to how the equity market is the real beneficiary from this cut. When I hear equity market is the beneficiary, what I hear is upper income, higher wealth Americans are the beneficiary here. And when inflation comes into play, that's the lower income Americans that are being penalized. So what we're seeing here, this stagflation type of environment, it doesn't hit everybody equally. It really exacerbates that K-shaped economy that's in play. And what's so challenging for a Federal Reserve here and their concept of the risk-free path is that no matter what direction they go in, they will exacerbate that K going forward. And that's why at this moment, this is a market, this is an economy, this is an economics profession that's going to have to think a little bit more deeply about whether we constantly go to monetary policy to solve what are increasingly structural problems and problems that are less rate sensitive. That is at the core of the statement we hear today, even if it's not explicitly mentioned, which is monetary policy is not going to solve the challenges that the U.S. is facing in 2026 and beyond, and they may actually end up exacerbating it when we rely exclusively on monetary policy.
Steve, I'm going to give you the last word before we take a little bit of a break here. Steve, you're going to be one of several reporters in this press conference with Jay Powell in the span of 23 minutes here. What exactly do you think most of the questions will be tilted towards? From my perspective, it would be what exactly has the Fed been looking at over the past several weeks if we've had no data?
I think that's a big part of it. And as I said, Dom, the lack of data shows up twice in the statement. It's kind of interesting that the person I want to ask a question of is not at the press conference. It's Jeff Schmidt. And I want to pick up on David Kelly's idea of whether or not this dissent is part of a single act by a Fed president, or is it part of a broader movement? There are a bunch of people on the committee who have expressed concern and caution about the cutting rates. And I want to ask Jeff if he's cutting rates because he's concerned about inflation being high, or is it the shutdown? Is there a reason that you don't want to do further rate cuts at all or move policy if you're out of the if you don't have the data that you need to make those decisions? So, and I am interested in whether or not there's some caution here, because we know why Myron wants to do it. He's sort of been there and done that. But this idea of whether or not there's now somebody who will step forward and say, wait a second, maybe with this inflation rate at 3%, we shouldn't be heading forward, changes the outlook for the market. I did note that the probability of a December cut is still very high, but it's not for January. January was still around 45% last I checked. One other thing is, well, I'll leave it there, Dom.
All right. A quick couple final thoughts from you guys. David, for you first.
Well, I think overall it does bring into question whether the Fed cuts quite as aggressively going forward. But for investors, I think the economy looks fine. It's not really, to me, a matter of the economy. I don't feel that the Fed needs to be cutting quite so aggressively, given where the market is right now.
Jim?
I think we're in a soft patch in the fourth quarter. I think that starts to turn around as we start to get into the first quarter. We get big tax refunds. The consumer is going to get a boost of capital just based on the One Big Beautiful Bill Act. Consumption, 70% of GDP. I still think there's going to be economic activity. Plus all the business investment, to me, leads to a little bit, it creates some robustness in the jobs market. So I would argue that going forward, I think the Fed gets to 3.5% in terms of the policy. So December, and then maybe one more in early next year. But then I think anything after that's an insurance cut. And I don't know that they have to go beyond 3.5% at this point.
All right. And Francis, to you for the final word.
Stagflation light is going to continue to burden this central bank. There is no risk-free path ahead. And now they have no clear data either. So a challenging time to be a central banker. Focus on the fundamentals driving this market and this economy.
All right. Francis, Donald, David Kelly, Jim, Karen, thank you guys very much. All-star group here breaking it all down. And to
Dom,
Steve. Yes,
just
Steve.
real quick, Dom. We are double-checking this notion. For sure that MBS rolls over into bills. I'm trying to figure out if it's accurate that treasuries roll over into bills. It may be that coupons roll into coupons and bills into bills. We'll double-check that and get back to you on that.
All right, we'll get the update from Steve on that clarification soon here. Thank you very much for your entire panel here. Let's now send it out to Chicago for reaction from the bond market and the pits out there. Rick Santelli joins us now from the CME Group out in Chicago. Rick.
There's a lot of turns and twists here, Dom. Consider this. A 2-year was at 351 before the announcement at top of the hour. You can see that we're slightly elevated in yields, and yields were already up a little bit on the session. But here's the point. You know where they were before the last interest rate cut? So they cut on the 16th, they cut today. On the 15th, the day before the September cut, a 2-year closed at 354. They're virtually unchanged. Look at the 10-year now. Okay, the 10-year was hovering right around 4%, so it's a little hotter since the announcement and the rate cut. Where was it the day before the September cut? 404, virtually unchanged. The dollar index, we see that it's highly unchanged since the 25 basis point rate cut. And the day after the 15th to 16th, when they actually cut rates, is when the dollar index made its multi-year low. So the point here is we're all talking about the Fed and cutting rates. It certainly looks like December's priced in, and Jim Carrett's probably right. Probably get one more next year. But the issue is we're all looking towards the yield curve and especially thinking about housing and the rest of the curve. But the rest of the curve is bucking the trend. We've had a cumulative 50 basis points, and basically the interest rate markets are unchanged. And since the October 1st shutdown of the government, the yield curve is flattening, which tells me there's nervousness that it's negatively affecting the economy. Back to you.
Rick, if I could just follow up here. What sense do you get from the trading community out there where you are in Chicago that the Fed is on the right path with a potential campaign or a trajectory of lower interest rates over the next several months?
Well, they like that because it most likely helps positions. But in the grand scheme of things, most sources I talk to think it's very difficult to grade what the Fed's doing because their GPS wasn't doing all that great when the government was open. The data was questionable. Now, how are they getting data? I know they put it together and there's a lot of anecdotal puzzle pieces they're using. But in the end, my comment would be, and I don't mean this in a derogatory fashion, but I think that the grade for the Federal Reserve is C at best with my sources, and they believe that the economy is going to reheat and definitely keep the rate cut cycle to a minimum compared to what some are looking forward towards 2026.
All right, Rick Santelli with the view from out in Chicago. Thank you very much for that. Now let's get a trader's take with regard to what's happening given the Fed interest rate decision, the commentary around that, and everything else we've heard from our all-star panel. Steve Grasso, CEO of Grasso Global, also a CNBC contributor, often seen on Fast Money. Take us through what your initial read has been, given what you heard about the rate story, what you heard about the commentary in there, and what you've heard from our panelists so far.
So anything less than a cut would have been a problem for the overall markets. I think that you're going to see Chair Powell is done in May of 2026. I think you're going to see 25 basis point cut every meeting that he's available to cut 25 basis points. I don't think you'll see a 50. I think that allows him to keep President Trump at bay, or criticism at bay, allows him to satisfy the markets, and allows him, just think about this, every quarter point cut, you know, the debt is at historic highs. Every quarter point cut saves the government $88 billion on an annual basis to service that debt. Sounds like a win to me. The markets think it's a win. Unemployment rate should probably be higher if the full participation rate is really moving in a static flow going forward. Off of the April tariff tantrum, what rallied the most? The most unprofitable companies, the unprofitable companies rallied the most. So we're starting to see sort of the mega cap tech take over leadership again. So I think you're going to go high and low. You're going to go unprofitable companies. You're going to go Russell 2000 companies that are really relying on variable rate debt financing, right? 30% of them rely on this month to month, Dom.
I think
this is a huge thing.
We saw something to the extent of that. I believe it was from Torsten Slok over at Apollo, showing the Russell 2000 profitable versus unprofitable, and the performance gap that we've seen with the outperformance coming from the not profitable Russell 2000 smaller cap companies over the course of this kind of year, and it's been expanding. My question then, though, is we've talked about this divergence and K-shaped recovery ever since not just the pandemic, but call it the great financial crisis lows. Something has to give at some point because inflation is still a problem. It's still out there. There doesn't feel like there's a view that it could percolate up again to the levels that we saw at 4-decade highs at points over the last 3 to 4 years. But it has to still be a concern if you're a central banker thinking about a cycle of interest rate cuts. Is it not?
Correct. What would you think, though, is more of a concern now? And this is what the Fed is trying to weigh. Is it price stability or is it full employment? And at this point, we're at a juncture where it is full employment. Reason why I say that is the tariffs really do that one-time price shock to the price of goods. And you can't really get your head around that, right? When you think about it, tariffs are going higher. It's got to be an ongoing basis. They don't go up once. They stay up once. So the amount of corporations that are passing it on, that could be different. But let's think about the Budget Act that President Trump passed. People are going to get roughly per household $2,000 coming in the door with those tax cuts. Tariffs are costing them roughly $1,000 per household. You know, these are averages. So they're actually above water on those tax policies. So that's where I think that most of the market is not pricing in. And then the full expensing, right? So that free cash flow, net profits, those are all tailwinds to the economy. But when you look at where we're at now, look at the amount of layoffs that we've seen in the last 30 days.
Just in white-collar jobs and white-collar jobs.
Tens of thousands.
Right.
Right? So if you're thinking, where do I want to really put my emphasis, it's on jobs right now. It's not on tariffs. We've already seen the bulk of inflation on that. I'd rather place my bets on cutting rates. And the 2-year is lower than the Fed funds rate. Does not happen often, especially in a rate-cutting cycle. That 2-year should be above where the Fed funds rate is, and it's still lower. So I think you're going to see us get back down to that neutral rate. They think it's at 375.4. I think it's at 275.3.
All right. So don't go anywhere, Steve. You're going to stick around here. We're going to talk a little bit more about this with our next guest here, a former member of the Fed's Open Market Committee, a former president of the Federal Reserve Bank of Dallas. Let's now bring into the discussion here Richard Fisher. Richard, you and I have spoken over the years at numerous times, and you've always kept a steady eye on both aspects, jobs and inflation. But inflation's always been a sticking point for a lot of folks at the Fed, you included. When it comes to the tilt of jobs versus the Fed's mandate on inflation and price stability, which do you think it should tilt more towards, given what we've seen so far?
Well, look, one of the very rare things would be to cut rates when you have 3% inflation or slightly under 3%, wherever the number is. We always want to keep 1% real rate. So this may be as far as you can push it right now. And maybe that's what the Kansas City Fed is concerned about. We'll have to see when we get a better briefing on the commentary. I think, again, every elected official, whether they're Republican or Democrat, Trump or Clinton, worries about employment. That's where the voter base is. But it is the Fed's job to have a dual mandate and to make sure we don't have inflation or deflation. So I think, of course, you have to remember, Dom, I was a hawk. So I always worried more about the inflation side than the other side. And with regard to that, the two dissents, Myron is obviously going to do what the president wants him to. He doesn't seem to be carrying the table. You got to convince 18 other people of your argument, and he's not winning that argument. As far as Kansas City is concerned, you have to remember Tom Honig, who's one of the great leaders of that bank, was also very hawkish and voted against a lot of what we did to cut rates when I was there. So it's part of a Kansas City tradition to be on the hawkish side. I do think it's an interesting indicator. I would expect Chairman Powell in his press conference is not going to signal anything further going forward. You have an excuse with regard to the lack of data that's available. And I think the other thing to mention, I think maybe only 4 times in history or maybe less, have we ever seen a rate cut when the equity markets are rallying to this degree, being priced relative to underlying value to this degree, when the spreads are so narrow in the credit markets? So I understand why a trader is rooting for more. From the standpoint of the real economy, Rick Santelli nailed it. Rates are not going down. And businesses depend on, not on Fed funds. Businesses depend on what's happening further out the yield curve. The 10-year Treasury is the most important of all in the entire world. It hasn't moved. And Rick made the point, and I think he's right, rates have been steady through all this rate cut discussion. That's what businesses depend on. To be sure, all the Federal Reserve beige book stuff is showing a slowing of the economy. There are other data that are showing it holding up. And remember, these big layoffs that have been announced, those are important. But what really counts is what small and medium-sized businesses that don't trade in the market, what's happening with their employment and how are they getting the kind of workers that they want. Historically, those little bitty companies that don't trade in the marketplace are the most important from an employment standpoint. They create 80% of the jobs in America. They hold roughly 50% of the jobs. So I think the key thing to watch here is what's happening in the SME, small, medium sector of businesses, and not get too caught up in the big companies. It's really the smaller companies, the non-traded companies that move the economy. So you have to diverge from the economy versus what the trading market wants to see. I understand why they want lower rates. I'm a little skeptical that they're likely to get them in December, and quite skeptical, unless the economy really implodes, that they'll get more following on that. Powell has 4 more meetings after this. And I believe, knowing him as I do, he's going to hold to principle, never give in to political pressure. And Mr. Myron may have a real difficult time convincing the rest of the committee that they need to move more aggressively.
All right. So, Richard, that's an interesting thought. Steve, I want to get your response to that, because Richard brings up interesting points with regard to the policy initiatives versus how the markets want things to go.
Right.
So you're the markets representative and not the central bank representative like Richard Fisher is. What exactly is your response?
I'm happy to change places with you.
No, I'm sure you are, Richard. I know you are, Richard. So, Steve, let's respond to Richard right now. Given what you said, then how he responded, what exactly is the market reconciliation with the economy and some of the pros and cons that we've seen in the absence of government data?
Right. So first, let me start off with, I always love hearing Richard's comments. I always value those. That's why he's on the network, and that's why he's been around for so long. So if you look at, he nailed it, right? Small companies supply 80% of the hiring. Do they want higher or lower? And he said it. They would rather have lower because they rely on that variable rate fluctuation. So they need lower rates in order to hire more. So I think we have to make sure the backbone of America on a jobs front has what they need to continue the productivity that they would like to continue. That's number one. Number two, think about existing home sales and new home sales. New home sales, you could offer incentives. You could buy down mortgage rates. But existing home sales, you don't live in a home, you live in a mortgage. So that's been locked up for so many years now. And that golden rate that many feel it's a golden rate is 5.5% on a 30-year fixed mortgage. We saw this during COVID. People didn't buy up as much real estate as they probably wanted to, but they did refinance a lot, and they refinanced around 3%. So we have a huge percentage that are locked in their homes. If we can lower those rates. Now, this is where it comes in to tie it all in. If you stop QT and you stop the $35 billion of MBS per month rolling off the balance sheet, that has the single most upward bias on 10-year yields. So if you stop that, which they are, that gives the ability for that mortgage rate to drop, hopefully precipitously. I don't know if it will be as quick as homeowners would like it to drop to get to that golden rate or below that golden rate, because that's where they'll take a leap. But I think for the economy, for homeowners, for smaller companies, Your people need lower rates to continue what they would like to do, to continue to spend money, to continue to take out debt and finance their debt. This is not only good for the average person on the street, this is good for the United States of America, that their debt financing will be tremendously cheaper the lower we go. I don't think inflation, and I appreciate Richard's comments, he's an inflation hawk, and I get where he's coming from. And he is right. I'm a market participant, but I'm well-rounding this all out. I could see both sides of this. I think to get from A to Z for the economy, for the markets, we need lower rates, and we need those rates around 3%.
All right, Richard, I want to ask you this question because as the former head of a regional Federal Reserve Bank out in Dallas, we've spoken a lot, and maybe even speculate is maybe not the right word. We've thought a lot about what exactly policymakers are using for data in order to get the best, I guess, view possible about what the economy is doing in the absence of any government-specific data coming out of the Labor Department, of Commerce, or anywhere else. One of those things has been the use of regional Fed banks and their kind of beige book participation type data to glean a better picture of what's going on. I would like to know from you, as the former president of the Dallas Fed, just how robust is that data coming into these regional banks, and how exactly can it be used, if effectively at all, by the central bank to help guide policy?
Well, it's not just the beige book, Dom. Every president, when they go to the meetings, which just concluded, they report what they see, what they're picking up to the minute in terms of their districts. Some districts are doing better than the others. Obviously, my former Federal Reserve District here in Dallas is one of the growth spots of America. But all of them are reporting a bit of a slowdown here. So a lot of it, yeah, again, please bear in mind, this is a judgmental business. There's no mathematical precision, despite what econometricians would like to infer, to making monetary policy. You've got 19 people sitting around the table, best judgment from all the stimuli and what they're hearing. They would like to have reliable, gold standard official data. They don't have that right now. So they are flying in a bit of a fog, but it's not with complete darkness. They're getting a lot of input from the banks. They're also creating alternative models to understand mathematically, at least from an econometric standpoint, what's going on in the economy. And I wouldn't say they're flying blind, but they are definitely in a bit of a fog here. The one thing I want to come back to what was commented on earlier. One of the reasons we bought up, and there's now $2 trillion in mortgage-backed securities on the balance sheet to this day, was to assist with the process of keeping those mortgage rates down when we put all that stuff on the balance sheet. And if you're going to start rolling that stuff off, it might have a negative impact in terms of mortgage rates. We'll have to watch. Here comes Powell.
Okay. No, we're going to wait just one moment here. Steve, we are waiting, as you can see here in the image, waiting for Fed Chairman Jerome Powell to take the podium. We've got roughly, call it maybe a minute 45. He's very prompt, by the way, Jerome Powell, stepping up to those podiums right now. So in the minute and 25 or 30 seconds that we have left, Steve, I'll give you a final word here. What exactly would you be wanting to listen for right now out of this press conference?
So I think a lot of these press conferences are checking the box, right? So Chair Powell is very good at playing it down straight down the middle of the fairway. I don't think he's going to tip his hand. I think he's going to say this was an insurance cut, and those will be the next insurance cuts based on trying to save the jobs market. I will leave you with this, and then I'll let Richard close it out. If you feel like the Fed is on time in making decisions, they're late. On time is late in the Fed policy world due to the long and variable lags. So if it feels early to you to be cutting rates, he's probably on time.
All right, so we've got a little balance here. Richard, I'll give you the final word. Your final thoughts before Fed Chair Jerome Powell takes the podium.
Point, remember, monetary policy, we used to think that it would take 18 months to have its impact. I think the period's much shorter now, but there is a variable rate of time that it takes for these decisions to actually hit the economy. The markets react almost instantaneously, right or wrong. But I thought that was a very good point. And we're just going to have to see how he handles himself here and what he says. And I expect him to be cautious. And the last thing I'll say is this: no Fed chairman has communicated this constantly with the marketplace. Remember, Volcker said nothing. Greenspan talked, but we couldn't understand what he was saying. He was just a great mumbler. And it was only every quarter that you might have gotten, or sometimes only twice a year, from previous chairman. Let's give Jay Powell credit. After every single meeting he meets, he also is open when he talks. And I think that's very important.
I'm telling you, he's prompt. Richard Fisher, I want to cut you off right now. Fed Chair Jerome Powell is taking the podium as we speak.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, as a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. if the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings. And we'll get lots of survey data. We'll get the beige book and things like that. So we'll have a picture of what's going on in the labor market. And the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the beige book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. how are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles. How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products. but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward. Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
And so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and And I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work is pretty close to zero. So maximum employment doesn't, on a sustainable basis, doesn't, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI, of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about, it's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher-end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information and you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument I don't know how persuasive it will be, but there will be an argument that you slow down when you can't see as far ahead. Others may argue. I mean, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that. So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian. Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. we're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop. It wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending. But it wouldn't be, you shouldn't think that it'll, dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much. In spending, but it wouldn't be, you shouldn't think that it'll, dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
We begin with breaking news. December is not a foregone conclusion. Far from it. The declaration of the afternoon from Chair Powell following the Fed's quarter-point rate cut. Markets, at least initially, not so much in love with that comment. Stocks did move lower. You can see the Dow and the S&P are still in the red. Yields moved up. At the same time, though, Chair Powell gave a pretty good review of the economy, saying it expanded at a moderate pace, at least based on what they can see, because they're not getting government data. As you know, the chairman giving a nod to that a couple of times in the statement as well as in the news conference. Welcome to Closing Bell, everybody. I'm Scott Wapner here at the New York Stock Exchange. We do have a very big hour ahead for you. We'll take you right up to those mega cap earnings coming at the top of the hour. We'll also discuss NVIDIA hitting $5 trillion in market cap today, the first company to ever do that. We do begin, though, of course, with our Fed Day exclusive. DoubleLine Capital founder and CEO Jeffrey Gundlach on this incredibly important day in the markets. Jeffrey, it is only fitting that you are here with us yet again. Welcome back.
Thanks, Scott. Thanks for having me back again. I think this is our 38th time after Fed Day, or 39th. I'm starting to lose count.
All right. Well, I'm glad we have continued the tradition. I really hit on that at the top. December is not a foregone conclusion. Far from it. Chair Powell went out of his way to say that.
Yeah, you're right. Yeah, you're right. In fact, that was going to be my phrase of the press conference. So you're on the same page that I am. Not a foregone conclusion. And then he reinforced that with far from it. And then he went back to that theme a little bit later on in the Q&A when he said, what do you do if you're driving through a fog? You slow down, which is kind of sounds to me like if we don't have any more data, I think that we need to price out to a certain extent what was an assumption by the market that there was going to be almost with 90+% certainty a cut in December. And I would say that has been reversed, or should be reversed. It's begun to be reversed, but I think it should be reversed fairly substantially. I might even put it at 50-50 when he says that there's far from a foregone conclusion. I saw in the pregame before the Fed announcements, I saw Rick Santelli talk about how the 2-year Treasury and the 10-year Treasury haven't changed since the last meeting, and he's right about that. I'd amplify that point, though, that the 2-year Treasury is down since before the Fed started cutting, or the day after the Fed's first rate cut back in September of last year. The 2-year Treasury rate is down all of 5 basis points. That's it. And the Fed has cut rates 150 basis points. Meanwhile, the 10-year Treasury rate and the long-term bond rate are up since the first rate cut, steepening out the yield curve. And I think that one thing I've been contextualizing all through these Fed cycles is that the Fed tends to gravitate towards the 2-year Treasury yield with the Fed funds rate. So back in September of last year, there was about 150 basis point spread between the Fed funds rate and the 2-year Treasury, with the 2-year Treasury being much lower. But now that the Fed's brought the rates down, they're very much in the context of the 2-year Treasury now, with only about a quarter point difference between the two. So I think what's really happened here, of course, is that we've seen tremendous rallies in financial assets this year. I mean, everyone's focusing on the stock market in the United States, but Europe's done well as well. Emerging markets have done even better. And bonds have done surprisingly well versus most people's expectations. This is actually, for the investment-grade bond index that is most commonly followed, out of the last 49 years, this is the 11th best year, following some pretty terrible years, particularly in 2022. So I think that we're looking at the possibility for a steeper yield curve. I think it's interesting. We're going to let the maturing mortgage-backed securities, they're going to reinvest them in T-bills. And he mentioned in his comments, Jay Powell, that they want to shorter-term securities, which is curious because that's the interest rate that they can control, that the Fed can control. So if they're really interested in thinking about reducing interest expense on the now $38+ trillion national debt, securities, and then you can do QE again if you need to. And I think that they may ultimately manipulate mortgage rates lower by possibly doing quantitative easing when the environment calls for it to get mortgage rates down. One of the biggest problems Jay Powell correctly talked about, and the inflation level has come down, but the price level is still very, very high versus 5 years ago. That also bleeds over into housing affordability, which is really bad compared to where it was 5 years ago. Home prices have gone way up, and mortgage rates are also higher than they were. And so it's just possible that they might want to buy mortgage-backed securities and get them to an even lower yield versus treasuries. I suspect that might be in the offing, not in the near term, but the intermediate term. And so we're quite positive on the agency-guaranteed mortgage-backed securities market, in spite of the fact that it's done very well in recent months, now having more excess return versus treasuries than investment-grade corporate bonds, which have also done well. So it's been a great year for financial assets. A lot of that had to do with the Fed assumption of more Fed cuts. I would say that assumption is getting a little weaker after today's press conference.
I like your willingness to give us, and our viewers, of course, actionable ideas. It's interesting when you say that maybe you're taking your own expectations for December down to 50-50, it obviously leads towards the road of the dissents, in which we got 2 today. Expected, of course, from Myron, who wanted 50 basis points, but Kansas City Schmid wanted none at all. I also thought it was newsworthy that the chair really underscored the idea of, in his words, decidedly differing views in the committee on what to do next. They got a battle in the room at this point.
That's what it sounds like, and it's understandable, you know, given the shortness on data and the fact that Jay Powell admits repeatedly that they've got a problem with their dual mandate. They're both going in the wrong direction, or at least inflation's not going towards 2% right now. It's over 3%, and we think it's going to stay above 3% year over year throughout, things can change, but throughout 2026. So the mandate, it's difficult to figure out what to do when, as he said, we only have the Fed funds rate at the Fed meetings, and one mandate says cut it, and one says don't cut it, or even potentially raise it at the inflation rate. So yeah, there's a battle in the room, and I think that's going to continue going forward. Myron is going to want 50 basis points every single meeting. I mean, that's where you're headed, and I suspect that's a taste of where we're going to be in, say, the middle of next year, when we have a new Fed chairman, which will probably be incrementally more dovish, and maybe more than incrementally more dovish than Jay Powell has been. So be interesting to see what's going on. I just really believe that there's chances for lower interest rates with the new Fed chairman that could be below the inflation rate, if possible. And we've certainly heard Donald Trump, and to a certain extent echoed by Scott Bessent, that they want rates lower, and not lower doesn't mean 3 7/8 in the middle point of the Fed funds rate where we are now. So we'll see what happens, but right now we're just enjoying a really great year in financial assets. I think one thing that's I'd like the viewers to think about, everyone knows that credit spreads are very tight, just like the stock market valuation is very high. Those things naturally go together. But the thing is, while corporate bond spreads in the investment-grade corporate bond market are tight, they're only about 75, some days 80 basis points more than treasuries. That's a very tight level versus history. It's really never been significantly less incremental yield for corporate bonds. And the same is largely true of below investment-grade corporate bonds, excluding the CCC category, which has some stress in it. You have the tightest spreads in the high-yield bond market, but both the investment-grade corporate bond market and the high-yield bond market are better off in terms of their credit quality and their dynamics than they were back before the global financial crisis, which was the last time we had spreads this tight. People who think that the history echoes, they might be worried about corporate bond spreads, but there hasn't been much change in them. And the fact is that the junk bond market is actually smaller than it was in recent years because a lot of the really bad credit is going not into the public corporate bond market. It's going into the private credit market. And that's actually a good thing for the public investment grade and junk bond markets because it means that the junkier stuff that would be a tell on what the default rate you might expect in the public bond market, it might be overstated this time because the defaults are showing up in more private categories. So we're not really negative. In fact, we added to investment grade corporate bonds at our most recent strategy meeting for the first time this year, simply because we think the fundamentals are quite good. And also, we don't like treasury debt at the longer end, and the corporate bond market tends to issue in the investment grade side in the 10-year category. So to the extent you want 10-year maturities, I think you might be just as safe in corporates as you are in long-term treasuries, because as the Fed eases interest rates and as the deficit grows, we've seen that in this easing cycle that started 13 months ago, long-term interest rates on treasuries have defied history. They have not gone down. Yes, they've gone down in the middle part of this year, but they're still higher and significantly higher than they were back before the first rate cut last September. So we're avoiding the long end of the treasury market. We'd rather have corporate bonds in the 10-year category. And we still like the best performing category more recently, which has been local currency emerging market debt, which is one of the best categories. Emerging markets broadly have done well. And if you're a dollar-based investor, you've done double well because you had done better on the index price changes, but you also have the currency translation, which translates to a profit for dollar-based investors. That's also true in the local currency emerging market bond market, which is the top performing sector in recent months. So we continue to be in that category. I have reduced my interest in gold once we got above 4,000. You'll remember all year I've been talking about kind of a radical prediction that gold would go over $4,000.
Yes, you did, including with me.
Yeah, and it's gone up. It went up to almost $4,400, which is really nosebleed levels. I mean, there are sentiment indicators called Market Vein, a service that polls investors on whether they're bullish or bearish on various categories, and you almost never get a bullish reading that's above the low 90s. But the gold reading a couple weeks ago was at 95, which is just unheard of. So last time we spoke, I talked about having 25% of a portfolio in gold or other types of hard asset things, which sounds high versus most people's recommendations, but it worked out pretty well. But I don't hold that any longer. There was somebody on the pregame that said what I think is now very timely investment advice, and that is, with all these market moves, you really want to think about rebalancing. Rebalancing is a very powerful tool. So you want to take things that are at nosebleed levels, like gold was a couple weeks ago, and if you had 25% gold, it probably turned into 35% of your portfolio. It was time to rebalance back down. Right now, I think gold has to correct further. We've seen about a 50% correction, maybe 40% of its big up move. But I would put gold now in my portfolio down to 10%, and I would have 5% in other commodities. Just a commodity index. So you'd end up with a little bit more than 10% gold and about 5% commodities. I still like 45% in stocks. You'd probably be higher than that now. You have to rebalance that because stocks have outperformed bonds. But I still like having some local, a dollar investor in emerging market equities. I still like that, and I like non-U.S. equities from a valuation perspective quite a lot. I like 25% in bonds, and it's the same game plan that we've been talking about. It's been working pretty much through the course of this year, and that's intermediate term bonds, maybe 2 years out to 10 years, with more in the 5 years than the 10 years. But also, not a lot of long-term treasury bonds. We own very, very little of long-term treasury bonds. We think the curve's going to steepen, and then we like these asset-backed securities and some commercial mortgage-backed securities, which I believe the market is starting to accept, even office commercial mortgage-backed securities. We're seeing interest. New York, there's always interest in Manhattan office, but we're starting to see better performance and better acceptance of Chicago office, and surprisingly, even some rumblings for San Francisco office. So this is a category that remains reasonably cheap. There's nothing super cheap in the entire financial markets right now, but we like and then I would have about 15% in cash right now, because I really think things are at a very aggressive level, not just gold, but which is certainly was at 4,400. But I certainly think that a stock market which is very narrow in breadth. I know it's better than it was before, but when I started following the stock market, it was in the early 70s. I was 12 years old, but they called it the Nifty 50, and that preceded a pretty big correction down, a pretty big drop in 1974. But now we have the Nifty 7. I know it's a little bit broader than that now, but there's a huge difference.
It doesn't feel it sometimes.
I'm not a momentum investor.
I know. It doesn't feel it sometimes, because we do have those huge earnings coming up, so it's going to be front and center. Hang on with just a second. Steve Leisman's come out of the room, Jeffrey. And Steve, I want to bring you in because I have to say, I don't remember a more forceful, I don't know if you want to call it rebuke, maybe it's just a pushback on market expectations like we got today from Chair Powell, who went out of his way to underscore December is not a foregone conclusion, adding far from it. What do you think?
I agree. He not only went out of his way to put some doubt into the December trade, but he noted that he was going out of his way to do that. It was pretty unusual. And it was in the prepared comments as if, I don't know if the committee agreed to have this statement said, but let's listen to what Powell had to say about December.
In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
So, Scott, what's happened to the probability of a rate cut in December is it's gone down. The last read I have, I'll give you one more here, 65%. It had been 85% going into this meeting. And January is sort of off the table as well. Actually, it's more in January now than it was in December. The direction is down when it comes to rates. I think that's pretty clear. The pace is something that Powell wants to reserve for the committee and the Fed as to how quickly it gets there. You could have listened to what Powell had to say today. Let me give you three things he said. Inflation is higher than target. They expect it to come down, but it remains, and it has accelerated for this year. That's one. And two is that he does not see further weakening in the job market. So in that regard, it would appear that the Fed is close to the having bought the insurance policy that it wants against job weakness. So maybe not all the way there. So there's another quarter out there probably, Scott, but the pace at which the Fed gets there is unclear. And it may be that December is a pause as the Fed tries to kind of create consensus around where they want to go. I'm surprised Schmidt didn't dissent last month or last meeting. And I'm also surprised and would not be surprised if there would be further dissents for two reasons. One is the lack of data, and two is the idea that if the Fed keeps cutting with the inflation rate above target, it's going to create the possibility or the concern that the Fed is off of its 2% target and it does not want to be there.
Yeah, Steve, thank you. I mean, it certainly matches the decidedly differing views as well that the chair underscored today in the battle, if you will, in the room over what to do in coming meetings. That's our senior economics correspondent, Steve Leisman. We're back with Jeffrey Gundlach. And the thing I wanted to talk to you about now is something else that the chair said towards the end there. I don't see a broader credit issue, is how he answered a question regarding private credit. You've had some of the issues around subprime auto, obviously, that we've all been focused on, wondering because of what Jamie Dimon said, there's never just one cockroach. You told me like 13 months ago that you were concerned, and this was out at Future Proof out in Huntington Beach. If you recall the conversation we had then, where I asked you, as everybody was talking about the prospects of a private credit bubble, you said you saw one. I'm wondering whether you now see the first cracks in it.
Well, there sometimes is one cockroach. I mean, that Silicon Valley Bank, that was sort of a one cockroach situation. A lot of people thought that was the beginning of something, and I was suspicious that I thought it might be contained, and it turned out that that was the case. But we are starting to see weaker activity in parts of the lower tiers of the credit market, and there's been more than one sort of write-down or default scenario that's already occurring, and they seem to be occurring kind of in a cluster. It's not like there's one and then 6 months goes by and then you get another write-down somewhere. They seem to be happening in a cluster, kind of like the layoffs are starting to happen in a cluster. So I think that private markets broadly have stopped outperforming public markets. That's certainly been the case in recent times with the public markets doing so well. I just think that there's going to be a liquidation that will occur in the next significant economic weakness period that is going to be surprising to people how much selling and unwinding there's going to be of what I think is an overinvestment in these private markets, both private equity and private credit. We're already seeing signs of some major asset pools that have got themselves into illiquid positioning because of significant investment in private markets, and they don't have any money. That was famously Harvard University back when they were getting, their donors were pulling back because it was going on campus. I think Yale's been talking about liquidating some of their private equity interests and the like. And that's usually the sign of overinvestment, and the liquidity will dry up and it will turn into sort of a liquidation cycle. That's my map. I don't think it has to happen this week.
Right.
But it's been a process that's been developing over the course of this year. But I think that's going to be at the foundations of the next kind of financial problem that we have in the United States, and perhaps beyond the United States borders.
Yeah.
But certainly, there's a lot of investment in that category. So I caution investors. I think if you have liquidity options, some funds, they allow a liquidity option. They'll give you a mark periodically on their private credit book, and if they allow a partial redemption and you don't see any degradation in the marks on the private pools, I would take advantage of that liquidity function, because I think you're going to be getting out at a better level than you'll be able to get out at in future quarters. So I'm very focused on private credit being an issue.
Okay, we'll follow that. There's certainly a lot of focus on it. You've given our viewers a lot to think about today and plenty of actionable ideas. For that, I thank you, and I look forward to our next conversation, which will be after the next Fed meeting, which now, who knows? Now what seemed to be a foregone conclusion, Jeffrey, is going to be anybody's guess. I look forward to being with you then. Thank you. That's Jeffrey Gunlock out in California for us. We're now in the closing bell market zone as we look ahead to these big tech earnings, which are really just 10, 15 minutes or so away. In overtime, Julia Borston watching Meta, Mackenzie Sagalos on Alphabet, Steve Kovac on Microsoft, New Edge Wealth's Rob Sechin owns them all. We're going to get this big setup. We have Big Technologies' Alex Gantrowicz, CNBC Senior Markets Commentator Mike Santoli. We got a big group because it's a big moment. Julia, I start with you to set the scene on Meta.
Well, Scott, expectations are high for Meta, given its beat on revenue for 12 straight quarters and earnings 10 times in a row. Those beats showed how Meta's AI investments improved user engagement and ad results. Q3 revenue growth is expected to hold steady at around 22% revenue growth. Meta did warn that growth would decelerate in Q4 on tough comps. So the question now is whether Meta's ramping AI investments will continue to pay off for its chatbot and Vibes AI video sharing platform. The key number to watch is CapEx. Meta last quarter raised the midpoint of its full year capital expenditures range to $69 billion. Now we're watching to see how much higher the CapEx guide is. Analysts expect 47% growth in CapEx next year to $97 billion. And overall, analysts are bullish. 87% have a buy rating, with the stock up 28% year to date. Back over to you.
All right, Julia, thank you so much. Perfect setup as we go to Mackenzie Sagalos now on Alphabet. Hi, Mac.
Hey, Scott. So investors are zeroed in on how Alphabet's core businesses are navigating the AI shift, especially search and cloud. So search remains the biggest pressure point. Google rolled out AI overviews and a new AI mode tab in Q2, but there's still no clear way to monetize it, and ads don't appear inside Gemini yet. Wall Street, though, is optimistic. JP Morgan says early data on AI mode shows growing query volume and stronger engagement, which could lift advertiser ROI despite fewer paid clicks per search. Now on cloud, Wolf Research is bullish on momentum from new wins, including Anthropic, Meta, and OpenAI, as Google leans on its custom in-house AI chips to expand capacity and gain share. And then YouTube, now the top streaming platform by engagement, remains a growth engine too, expected to top $10 billion in ad revenue this quarter, Scott.
Mackenzie, thank you. Can't wait to see what happens to Steve Kovac on Microsoft. $4 trillion market cap, and now a lot to live up to.
Yeah, and also on a day, Scott, when the Azure cloud service is down, it's actually took down Microsoft's IR website. But anyway, the key thing to watch here is Azure and the growth that has been fueled by AI. Yesterday, we got that OpenAI deal, and we know there's going to be that $250 billion commitment from OpenAI to spend on Azure cloud. The difference with that deal and so many others that we've heard, this is a contracted deal. It's not nebulous like other deals OpenAI has done with companies like Oracle. So let's put away some of the worries about AI CapEx slowing down. I'll give you an example. I was in Wisconsin just last month looking at Microsoft's new data center being built, and right next door, before this one even opens, they're building another more expensive one. And Microsoft told us just a few weeks ago they still can't meet all the demand, and they're in fact turning away customers so they can support their current customers. Now, CFO Amy Hood 3 months ago in the last call originally predicted they would catch up to demand this year. That's now pushed into next year. As for CapEx guidance for the quarter, they are already trending to spend more than $100 billion for the fiscal year ending next June. We'll get some idea of what the December quarter spend looks like in just a few minutes, Scott.
All right, thanks all. That was great setups for us to begin our conversation right here on the desk. AK, Alex Kantrowitz, who has the most to prove tonight?
I would say it's Meta. And, you know, it's one of those things where we'll see quarter to quarter, Meta will turn in some advertising, really impressive advertising results. But what I really want to hear from Mark Zuckerberg on the call today is some vision around his AI plan. Remember, he's invested billions of dollars in talent. He's reorganized his AI division many times. There was just a report last week that they're letting 600 people go. Is Meta just building another chatbot? And if so, how defensible is the money that they're making today? Because I would say Meta really faces a challenge long term as people decide that they want to become friends with these chatbots as opposed to mitigating their friends with humans through the online social media platforms. That is an existential threat for Meta. I really believe so. And we're going to have to hear something from Zuckerberg about where they want to go.
You feel the same way, Rob, as you own, as we said, all three stocks, this being Meta, the underperformer of late in the group.
No question, it's Meta. We need to see continued ad engagement measured by increasing price per ad, increased impressions, increased time spent, where AI investments have started to yield results. Expectations are for daily active users to increase by 6%. Once again, that's remarkable for a company that has 3.5 billion active users, when outside of China, there are only 4.5 billion people with internet access. That suggests that 75% of the world has access to Meta and is using them on a daily basis. Healthy trends which suggest that the company can continue to invest heavily in their AI infrastructure, but it also allows them to aim for their long-term goal of having top-tier models.
Who do you have the most confidence in tonight then, Rob?
We talked about it on your other show this week. Scott, it would have to be Google. I think they continue to quiet the narrative around search disruption and prove that Google Cloud is gaining market share. Expectation are for search revenues to rise 11% year on year. That's up 9% from Q1 and matches the prior quarter. Healthy results here would illustrate that they are fending off increased competition from AI models like ChatGPT. Cloud expectations projections are for 30% revenue growth year on year. That would be 8% sequential. It's a smaller base relative to Azure, but it suggests that they're gaining momentum, and customers look to Google for AI compute and access to their AI models. I think they can deliver on these. Plus, it's I think it's the least expensive of this cohort right now going in. So I think that's the big news. Okay. I think the other thing, Scott, just one quick thing, is it's hard to emphasize just how important these companies are. As the market gets more and more narrow, the results from these companies are imperative for new highs. It's just given their size in the indices, a bull market in the Mag 7 is a prerequisite for a bull market overall. And they've been experiencing supernormal growth. Is the question that we have is, can that supernormal growth continue as they face stiffer competition from one another?
We hear you, and it's a perfect segue to bring Mike Santoli into the conversation, because nobody sees the big market picture as well as you do, to tell us what's really riding on this. Now, if you say, well, rate cuts might be in question moving forward, does that make these all the more important now?
Well, just look at the market action today, and it implies the stakes have risen for this segment of the market, kind of as Rob was saying. So after we got that, admonition from Chair Powell that, hey, don't count on a December rate cut, whether in fact we take that and run with it or not, you see home builders down 3%. You got regional banks down 2% on the day, and you have extreme negative breadth in the overall market, even as the S&P 500 is slightly green because NVIDIA is up, because semis are up 2%. So I do think it's about market reaction to what are generally going to be good numbers. And, I would kind of agree with Alex in terms of Meta. If there's going to be one company where the market will express impatience about the strategy or the volume of spending or the character of the spending, it might be Meta. On the other hand, in terms of field position, Google's way extended out there. I mean, the confidence that Rob and a lot of investors have in the story is getting reflected in the stock. It's up 90% from the April low. It's up 10% in a week. Why is that? Well, it got too cheap. And so I think the question is, do you still have a valuation buffer in Alphabet? But in general, the market has become more narrow and top-heavy, and the very fashionable trade of last year going into 2025 of say, hey, rotate into the equal-weight S&P, it's on the dead lows against the market cap-weighted S&P, unfortunately.
AK, what do you make of what Rob Sechan had to say, the most confidence in Alphabet at a time where we are questioning where their search leadership is going to end up based on some of the announcements that we have already gotten? Is it misguided, or is he just right?
Well, we know that Alphabet, they're going to grow double digits. We're about to hit the 3-year anniversary of ChatGPT, and everybody believed that this would at least be some hit to Google search. We're starting to see that actual search behavior and conversations with generative AI are starting to diverge a little bit. They might be two separate behaviors. And by the way, Google has the model with Gemini, so they're going to be able to capture both. Then they have a story in terms of capital expenditures. Last quarter, the real story around Google was, they're going to spend more to meet this demand around cloud. A couple weeks ago, they announced this deal with Anthropic, where Anthropic is going to spend tens of billions of dollars on their cloud services. So it's money that is leading to revenue on the Google side. So defending search, but also have a growing cloud story is about as perfect of a position as you'd want to be if you're Alphabet, and they might actually have that.
Let's focus on the company that we have listed there across the bottom of your screen, flashed in red, for good reason, too, because NVIDIA did become the first ever company to hit $5 trillion in market cap. Rob, what is most amazing to me, certainly high on the list, it only took 80 trading days to add $1 trillion in market cap for this company. July 9th, $4 trillion. Here we are late in October, and we've gone $1 trillion higher.
It's hard to imagine that there's any more important company in the entire world than NVIDIA. Look at yesterday, 70% of the S&P 500 stocks were down on the day. The average S&P 500 company was down 1%, and yet the index was positive thanks to the contribution from NVIDIA. When you have an environment where less than half the stocks in the S&P are trading above their 50-day moving average, that's usually a cautionary sign and tells us that there isn't much support for the market if we lose the leadership of the biggest AI and secular growth companies. This virtuous cycle has to continue to deliver. You mentioned on your show earlier today a lot of the cuts that we're seeing in other parts of the market, Scott.
Right.
You know, you
That's
need
good.
this to
Rob,
deliver.
I'm going to move on to Mike Santoli. I appreciate you joining us. I want to give Mike the last word because that's what he gets.
Yeah, well, I tell you, I appreciate it, but it's honestly just the irresistible brute force of the actual revenue trend that is almost more remarkable than the capitalization of it in the market cap. Because if, in fact, it's going to be $500 billion in revenue in 5 or 6 quarters, we've never seen anything like that. It's moving so fast. They are collecting the free cash flow of the rest of the industry, and the market's happy with it. The market's fine with it. They have 50% margins on it. At some point, again, it's a source of instability at the top of the index if it keeps racing and everything else is left behind. But for now, making it work through rotation.
For being here, of course, and Mike Santoli as well. You obviously can hear the bell. We'll be red into these big earnings. NASDAQ's going to be green, though. That's key with Morgan and John now.
That bell marks the end of regulation. Moody's ringing the closing bell at the New York Stock Exchange. Team USA doing the honors at the NASDAQ as we're 100 days from the Winter Olympics. Stocks closing mixed. All 3 major averages hit record highs early in the session, then pulled back. After the Fed decision rebounded into the close, the Fed cut rates a quarter point, which the market liked. Chair Powell cast doubt on another rate cut in December, which the market didn't. The NASDAQ closing at a record high, though. NVIDIA continuing its gains, up 14% in a week, more than doubling off the April lows. It peaked above a $5 trillion market cap for the first time, first company to do it. Caterpillar contributing nearly 400 points to the Dow's gain after reporting better than expected earnings and revenue. The company saying it saw strong growth in its power generation unit thanks to the boom in data center construction. And some of the Dow names offsetting the positive impact, though, of Caterpillar and NVIDIA, Boeing, United Health, Visa, and McDonald's. Bloom Energy, another big AI winner, beating on earnings and revenue, citing, quote, surging demand for electricity driven by, what else, AI. And check out the yield on the 10-year note, rising back above 4% after the Fed decision, and gold prices lower once again today.
Well, that's the scorecard on Wall Street. Welcome to Closing Bell Overtime. I'm Morgan Brennan, along with John Fort. We have an incredibly busy hour of earnings coming up. In the next few minutes, we're going to get reports from 3 of the Mag 7, Microsoft, Meta, and Alphabet. Total combined market cap exceeding $9 billion. The 3 of them make up 14% of the S&P 500. And if that's not enough for you, we're also going to hear from Starbucks and Chipotle, a host of other names we're watching as well, including ServiceNow, eBay, MGM Resorts, Carvana, and KLA.
And there was also a Fed decision this afternoon. The Fed cutting rates a quarter point. We'll talk to Jefferies' David Zervos coming up. And now let's begin with our market panel. Here to help navigate earnings, the Fed and record highs, Hightower Advisors Chief Investment Strategist, CNBC contributor Stephanie Link, and CNBC Senior Markets Commentator Mike Santoli. Stephanie, how big a beat do we need for the market to move higher here, particularly from these big names, Microsoft, Meta, Alphabet, reporting here? And Alphabet, I'm hearing, is out. We're going through it. Stephanie, can you hear me?
Oh, sorry. Yeah, I can hear you now. I'm sorry, John.
Okay.
Look, I think these are really big reports. Obviously, they're a big representation to the overall S&P 500 in terms of the weightings. There's a lot riding on these results, but I do think they're going to be good. I'm the most nervous about Alphabet only because it's up so much from the second quarter, up 30%. I think Meta will be good. It's also down 5% since last quarter, and I think the expense side is going to be the key. And Microsoft, can they live up to the better cloud numbers that is expected? So high expectations, but I do think overall the fundamentals are going to be very strong. And if there's any weakness, I think it gets bought.
Mike, as part of the question, are the times good enough for the biggest companies, for the most well-heeled in this economy, that they can continue to pull the rest of it through?
For now, yes is the answer. It's more erratic under the surface. I think after the Fed decision and Powell's hawkish tone, you did see the makings of some concern in the market for a potential growth scare. Regional banks, consumer discretionary, home builders, and the like. We'll see if that still continues into tomorrow as we digest it. So yeah, it makes it a little more of a top-heavy story,
Mike,
and these companies have to come through.
We're going to cut you off there because we got Mackenzie Sagalos with Alphabet results for us. Mackenzie. Hey there, Morgan. So we got shares moving 3.5% higher in the after hours. Now with EPS, Alphabet reporting a GAAP EPS number here of 287. That's not comparable to analyst estimates due to a one-time $3.5 billion charge that they got from the European Commission that's related to distorting competition in the ad tech market. Now revenue, that's a big beat here, 102.35 billion. The street was expecting to see 99.89 billion. I've also got a cloud revenue number for you for Q3. That's a big AI demand indicator. It's coming in at 15.16 billion versus an expected 14.74 billion. I'm still digging through this report, Morgan. I'm going to come back to you with search and other revenue, YouTube revenue as well. Those shares now up more than 5.5%. Yeah, and climbing. So Stephanie Link, I'll go back to you to get your reaction to the initial numbers we just got from Alphabet.
Yeah, obviously a total revenue beat is great, but cloud revenue really nice. 15.16 billion versus 14.7 billion expected. Momentum continues. It'll be interesting to see what Microsoft reports, and then of course Amazon when we get Amazon's results. But the cloud numbers, the tailwinds, Morgan, are just enormous. And you still have enterprises that are still migrating to the cloud, right? There's only 15% of workloads that are on the cloud. So there's a lot more to go. I think all three can win. I am surprised by the reaction just because Google's had such a nice run, but obviously these are great numbers.
Yeah, it also looks like, and again, this is just headlines I'm seeing on the screen here, CapEx for 2025 of Alphabet of $91 to $93 billion. Mike, want to get your response to this, especially as we see shares of Microsoft turning lower right now as we await those results.
Yes, of course, Microsoft, there was a bit of a relief upside trade after the terms of the OpenAI investment came out. So I don't know the details of the, initial disappointment there. But when it comes to Alphabet, pretty high bar. They've cleared it. Stock still benefits from it being at a discount valuation-wise to the likes of Microsoft and other comparable names. So I do think that's why you have that positive. And then, the revenue acceleration in cloud, as Stephanie was saying, is something that is going to tell you that we can still tolerate the higher CapEx because it's obviously being put to good use.
Stephanie, there's an interesting dynamic happening here with some of these big tech cloud names. AWS growth was not as strong last quarter as some investors. Hold on, we got the Microsoft numbers. Steve Kovac has them. Steve?
Yeah, John, we see shares dropping here despite some beats on the top and bottom line and on Azure cloud growth. EPS was a beat at $4.13. Street wanted to see $3.67. Revenue here, a beat as well, $77.67 billion. Street was looking for $75.33 billion. And Azure cloud growth, again, another beat here, 40% growth year over year compared to expectations of 38.2%. We're seeing shares drop here about 4.5%. I'm going to keep digging through and find out what's going on, and I'll be right back with some more color for you guys.
Okay, Steve Kovac, thank you. Those shares are down 4% right now. But we have more earnings to bring you. Starbucks results are out. Kate Rogers has those numbers. Hi, Kate.
Hey, Morgan. So the stock a little bit higher here, as you can see, by more than 1.5%. A mixed fourth quarter for Starbucks. EPS a miss here, 52 cents adjusted versus estimates of 56 cents. Revenues, though, a beat, 9.6 billion for the quarter versus the 9.35 billion estimated. And that's even with the labor investments that the company is making right now. Comps turning positive globally. Q4 comp sales up 1%, better than the 0.3% decline estimated. Q4 North American comp sales flat versus 0.9% estimates. Transactions declined in North America, but noteworthy update here. U.S. comps did turn positive in September as the company's Back to Starbucks plan takes shape. Q4 international comp sales also better than expected, up 3%. It's China same-store sales, second home market there, also up 2%. We're going to be looking out for any guidance and any updates on China and that market on the earnings call, guys. We'll bring you updates as we get.
Kate, thank you. I do want to mention that Meta results are out. Stock is headed lower. And we can go to Julia Borston on. I wonder if you can see why the stock is down 7% or so.
Well, earnings and revenue both beat expectations. Adjusted earnings of $7.25. That's ahead of estimates of $6.69. But that includes a one-time non-cash income tax charge of $15.9 billion. But that without that one-time charge, which is due to the big beautiful bill, President Trump's big beautiful deal bill, that would have been an EPS beat. Revenues
the market is closed.
Estimates. Daily active people ahead of estimates 3.54 billion versus 3.49 billion estimated. And the average price per ad was up 10% in the quarter versus an 11% gain that the street account estimate had anticipated. Now, in terms of Q4 revenues, the company is guiding to Q4 revenues between 56 billion and 59 billion. That compares to the 57.25 billion estimated. And they say the outlook reflects an expectation for continued strong ad revenue growth, partially offset by lower year-over-year Reality Labs revenue in the fourth quarter. We're going to continue to dig into this. Does seem like everyone is working through this one-time non-cash income tax charge and its impact on the company, as well as some other factors. Back over to you.
All right, Julia, thanks. That stock still down more than 6.5%. Microsoft's off the lows, but still down nearly 3%. Alphabet, though, Google's parent, doing better than the rest. Let's get back to Mackenzie Sigalis for some more details on that report. Mac?
Hey there, John. So one number that we were looking out for is its full-year CapEx guide. It's now ranging between $91 billion and $93 billion. That puts it very close to the numbers that we've seen from Microsoft and Amazon, the two biggest spenders in that cloud war. They've got CapEx commitments of around $100 billion. It's backlog number, so that's the best indicator of future revenue. That's coming in at $155 billion. Also key here, it's Gemini app, which goes head-to-head with OpenAI's ChatGPT. It's looking at monthly active users of 650 million versus OpenAI's 800 million. I want to bring you that all-important new number. This is its cash cow for the company. We're looking at $56.57 billion for that segment, beating estimates of $55.1 billion. We are seeing a miss in its other bets revenue. That's $340. $433.1 million. That's where its Waymo business lives. One other thing for you I've got, John, is your it's your Q3 YouTube revenue. That's beating estimates at $10.26 billion versus the $10.01 billion expected. And last thing I'll say for you, that cloud revenue growth, that percentage growth, 34
talent and technical talent in priority areas. Not a specific number for 2026 CapEx, but indicating that the number is going to continue to grow. Back over to you.
Yeah, I know. With some of those big ticket hires, a lot of folks looking at that number. Julia, thank you. Those shares down 6% right now. Steve Kovac, I believe we're going back to with more on Microsoft.
Yeah, that's right, Morgan. One possible explanation, I'm digging through the numbers here to explain why we're seeing the shares go down. Intelligent Cloud was a slight miss. We're looking at $30.9 billion compared to $30.25 billion. It's a very tiny miss. But that said, it's the only miss I'm seeing in the metrics that we follow closely here. We're going to get some more data here on the earnings call. That's when we're going to get those CapEx numbers, guidance, and so many other things that could move the stock the other way. But right now, a miss on Intelligent Cloud is the only thing I'm seeing that could be a drag on the stock here after hours, guys.
Well, near record highs for the major averages in so many of these names. Perhaps we're priced for more than that. Let's get to Kate Rogers now on Chipotle with their earnings. Kate.
Hey, John, the stock kind of bouncing around a bit in the after hours here. Now it's higher by more than 3%. Its third quarter results essentially in line for Chipotle. The company lowering, though, its full year same-store sales guidance now for the third quarter in a row. It now expects low single-digit decline versus a prior forecast of flat. Now, that's despite its EPS coming in right in line at 29 cents. Revenue is also in line at $3 billion for the quarter. Same-store sales also up 0.3%. Its average check is up 1.1%, but traffic did fall by just under 1% in the quarter. Restaurant margin about 24.5%. That's 1% lower than analyst estimates. It says due to higher beef and chicken costs along with the impact of tariffs. Now, CEO Scott Boatwright telling me in a CNBC exclusive interview that younger consumers under 100K annual income are pulling back a bit in the quarter. Take a listen.
We've seen a pretty sizable step down in the consumer that's under $100,000 in annual income. Specific to that is a group that 25 to 34-year-old, which we over-index to, has pulled back measurably. And we believe that consumer is now eating at home more often, not necessarily eating with our competitors. Based on our information, we're still gaining share with that cohort. They're just spending considerably less in restaurants.
So he's saying it's really happening across the board here, those macroeconomic pressures. The company plans to lean further into messaging around its value proposition, Boatwright telling me. And you can see, again, the stock higher by more than 2% on this report, guys. Back over to you.
Kate Rogers, thank you. Want to get to Stephanie Link on Chipotle because I believe you own it. Now, this is a stock that I believe is down 34% year to date. So if people are wondering why it's up on results that seem more disappointing versus expectations, some of the big tech names, perhaps it's being measured by a different standard, Stephanie?
Oh, absolutely. Absolutely. Look, I mean, it's hard in general for this industry right now from a macro point of view, but they're doing the very best that they can. I think that the expectations were for a negative comp for the quarter. So to be kind of around flattish is not a bad thing. I think they're kitchen sinking the low single-digit declines in same-store sales for the next quarter. Restaurant margins are coming down, but they're still industry high. They have, I believe, $500 million left in their buyback, or 1% of the market cap. So, I mean, they're doing the best that they can in terms of delivering on the cost structure. They've got products, they've got digital, and they've got a menu that they're revamping as well and adding to, and I think that will lead to better comps going forward. But this is absolutely classic, terrible expectations, because the stock has been terrible year to date.
All right. And I know those comp sales are what were in focus for Starbucks, too, talking about turnarounds and lower expectations. I want to get your thoughts on what we saw with Meta, with that stock trading lower right now. I mean, higher CapEx for 2025. It's going to be even higher next year, but a lot of noise in this quarter with that cash charge.
Yeah, I mean, look, I think the numbers look pretty good in terms of the growth, but people have always been very sensitive to this excessive spend. And so for them to increase their CapEx to $116 to $118 billion for this year, from $114 to $116, that's a disappointment, number one. And number two, to be notably larger in 2026, that's not going to sit well with people. We just want to see operating leverage at this company, and we had been seeing that over the last couple of quarters. This is actually a departure from that, and I get it. They're building out data centers up the wazoo. They're hiring all kinds of talent for AI. They're doing it for the long term to continue to grow. But I think, near term, it's disappointing. Now, I would say ad impressions actually up 14%. That's a good number. That's a really good number, better than expected. And pricing of 10%, that shows that they're monetizing AI. And they're one of the very few that are spending all this money that is monetizing. We just don't want to see them spend this much.
But, Stephanie, the flip side of this, isn't it? I mean, you got NVIDIA touching that $5 trillion market cap, in part because folks like Meta, and there aren't that many, but folks like Meta are spending all that money on the infrastructure. So do you see anything here that's either derailing or bolstering the AI storyline that's been powering this market so much? These big names are continuing to spend. Meta perhaps seeing some results out of that. I don't know if the intelligent cloud mix out of Microsoft causes any concern, or if we have to wait for detail on the call to hear exactly what was going on with that.
Look, I think the spend is there, and it is gradually increasing, probably at a little lesser rate than that had been growing at. but they're still spending because the demand is still there. We're in the second innings of this. So it depends on which way you want to play it. You can play it with Mag 7 because they're delivering on the growth side, some monetization, they're delivering on the free cash flow, and they are investing for the future. Or you could go downstream in terms of technology. You've mentioned NVIDIA. Look at Broadcom. Look at Teradyne today, up 20%. We don't even talk about them. Then we go into Morgan's world on industrials and look at all of the grid manufacturers or improvements that we're going to see. Look at the data centers that we have to build. Look at the power that we need. So you can own things like Quanta Services and Eaton and Rockwell Automation and GE Vernova and Vertiv, which is one of my favorites. So you could do that, or you could even go to the utility companies. So you're seeing spend across the spectrum of between tech and between utilities, industrials, and that's why I don't think it is a bubble. But, you know, certainly the ones that are spending more, and we don't want to see them spend more, that's why they're taking a hit. By the way, Microsoft, I think, is down only because Azure grew 39%, but the last couple of quarters, they have been beating expectations by 300 to 400 basis points, and they only beat by 200. So I mean, really, that's silly. If the stock is down just because of that, you buy that stock.
Well, Meta and Microsoft also both up more than 25% year to date. Stephanie Link, thank you, taking us across the market. Well, Microsoft, Meta, Google, all reporting so far this hour. Microsoft's lower, Meta losing what? 7.5%. Alphabet is the gainer in that bunch, up almost 6%. We've got analysts lined up to react to all those reports, and Overtime comes right back in 2. Well, ServiceNow earnings are out, and the stock is up more than 3.5% here in Overtime after a beat on the top and bottom lines, a raised guide, and the announcement of a 5-for-1 stock split. ServiceNow revenue came in at $3.41 billion versus $3.35 billion consensus. Earnings per share, $4.82 adjusted versus $4.27 expected. I spoke with CEO Bill McDermott about the results this afternoon on higher margins. He said, you're seeing margin expansion on the op margin level and the free cash flow margin level, not only in the quarter, but we're going to raise the guidance for the full year quite substantially. And then on the guide and the government shutdown, he said, we are beyond any of the high-end expectations on Wall Street without the upside in public sector. And the only reason we're not putting that upside into this particular guide yet is because the government is shut down. In other words, if it ends sooner, the quarter gets better. Morgan, this is a software name that has very much been driving a good part of the AI story. And, I mean, hey, it's up, which is something with the high expectations we've seen so far in Overtime today. A little bit of an anomaly.
Yeah. Certainly notable here. Well,
you can hear much more from ServiceNow Chairman and CEO Bill McDermott coming up on Mad Money, 6 p.m.
okay, let's get another check on Microsoft, too. Speaking of stocks with big moves this hour, those shares are actually falling. That's despite posting a beat on the top and bottom lines. Azure growth also came in ahead of estimates, up 40% year over year. Joining us now is Brent Thill from Jefferies. Stock's down about 3.5% right now. Brent, why?
Azure was a slight miss. The street wanted a little bit higher on that growth that you just mentioned. And I think that's really largely it. All the other metrics look good. I think the street's not picking up on the booking and the actual RPO. And if you look at those numbers, you're talking about a commercial booking number at 112%, a 50+% growth in RPO. That's one of the best growth rates we've ever seen. And that does not include the new commitment from OpenAI of $250 billion incremental. So OpenAI helped them in the quarter, but all this $250 billion is not in that number as they indicated in the release. So I don't think the market's picking up on that. So that to me is the future indication of health of this company is just blew the doors off on RPO and bookings growth, which is again the most important thing that we look at as software analysts. What's the future indication of health? That's it. CapEx was a little bit higher, which everyone had expected, and you saw Google and Meta also raise their guidance. So everyone's asking what's happening to CapEx. We just got basically a raise from all three, from what we can see. And then when you think about margins, everyone's like, well, how can you make money in AI? She put up, Amy, the CFO of Microsoft, put up better margins than expected. So this is further indication that they're making money on AI, that they're not effectively losing capital on this investment. They're actually driving really good margin improvement.
So the stock's down 3% in overtime right now, and I realize we still have to get through a conference call here, too. Do you buy on this dip?
We do. If you look at the booking number, you can't find too many companies growing their backlog, commercial book backlog over 100, and their RPO, which is the remaining performance obligation, over 50. And that's an indication of what's to come for the next several quarters. So we're buyers on Microsoft.
How does this speak to what we saw from Amazon last quarter? They talked about being sort of supply constrained on offering up cloud. It seems like some of the names that were less constrained in how they approached the cloud last quarter continue to accelerate here. What does that mean for the whole hyperscaler environment and what investors are both expecting and hoping for in top line growth and business momentum?
We're year 3 in AI build out, and many are indicating it's a 20-year cycle. We have, as a software analyst, we do a lot of work in talking to the data center experts, and they have line of sight on 5 to 10 years of work. So anyone that thinks this is a 1 or 2 quarter or 5 quarter investment cycle, they need to check in the field. What's going on is this is a multi-year investment cycle. And so we continue to see CapEx numbers going higher. That should result in effectively higher growth for all the hyperscalers. So we think, again, we look at Amazon, to your point, they put up 25% backlog growth. They should accelerate their total revenue growth on AWS as a further indication. So overall, I think we're nitpicking on Microsoft on Azure.
Okay.
1 point, it's not like they missed wide right.
Right. So how important is it? You mentioned Meta. We'll talk about that a bit later. But Microsoft is sort of building software, selling software on its own infrastructure here. When we hear about the degree to which they're getting margin demand for their AI services on top of Office, on top of some of the other things they do, is that important for the valuation and expectations that investors should have about the impact for the bottom line of AI?
Yeah, I mean, as I said, the margins are close to 40%, which is everyone thought margins would go down as Microsoft entered AI 2 years ago. What they've done in the last 2 years is showed you margin improvement. And that's testament to Amy Hood, who, again, is the best CFO in software, hands down. And as long as she's at the helm, she's going to keep driving efficiency. And they're not losing money on this endeavor. They're actually making money, and they just showed you that they can improve margin. So again, I've seen, the last 2 years, and you think about it, in the beginning of a tectonic shift that we're seeing, that you're showing margin improvement, it's because they're able to price for it. They're charging a higher price, and they're able to make money on these services. And as I've said, Microsoft is the best position of any hyperscaler to monetize AI because all the hyperscalers don't live in the application world. the degree that Microsoft does. They can monetize in productivity apps and off-the-shelf ERP, Salesforce automation, custom apps, vibe coding, security, infrastructure. Every CIO is going to Microsoft because they're the one vendor they want to be in a rowboat to a deserted island because they have the entire stack infused with AI. And then from a financial analyst perspective, it's hard to compare when you've got improving margin, good cash flow, and they're doing all the right things. And again, the bogey line maybe just was a little bit higher, so that's why stock's off a couple points. But again, this does not include the OpenAI $250 billion deal. They highlighted that, and that's trapped. So that's what is yet to come. And that RPO will give you a future indication that things are really, really good right now.
Okay, Brent Thill with some good context there. Thanks. The shares of Microsoft down about 3% right now here in overtime. Well, up next, we are going to turn our attention to Alphabet and Meta. The stock's moving in opposite directions. Google's seeing a nice jump as search revenue beats, while Meta is falling hard. We're going to dig into both of those results ahead. We'll be right back.